Ladies and gentlemen, welcome to our weekly investor update. I'm your host, Rachel Curlew, AVP of Investment Banking. Today, we're discussing Stationery and Office Supplies Jamaica Limited and Wigton Wind Farm Limited. I'm joined by our regular panelist, Asha Smelly, our Assistant Sales Manager and frequent co-host here on the channel. Glad to have you as always, Asha.
Glad to co-host with you again, Rachel.
Don't forget to subscribe if you like the content. Also, hit the bell to stay up to date with the channel. We upload content like this every week. Also, if you want to embark on your first investment journey, you should take that first step with Mayberry. Follow us on social media to learn more about how you can get started today. So let's get into it. I'll start with Wigton Wind Farm Limited. Just a quick recap. Wigton owns and operates a 62 megawatt wind energy generation facility in Manchester, which supplies electricity to JPS and by extension the national grid. Mayberry listed this company back in 2019, raising $5.5 billion from the main market. It's currently trading at 89 cents with a market cap of just under $10 billion. We're seeing where the stock is trading at a PE of 14 times, slightly above the main market mean average. While a PE of 14 times may be viewed as high for the main market, this company still has room for growth. Wigton is the oldest and largest renewable company in Jamaica with plenty of cash on its balance sheet, almost $4 billion. This places the company in a great position to win some competitive bids as they aim to expand and increase production. For the 9 months period ended December 2022, Wigton reported a 12% increase in revenues to $1.8 billion, up from $1.6 billion the prior year. Cost of sales went up marginally by 1% to close at $640 million, which resulted in a gross profit amount of $1.1 billion. General expenses and finance costs declined 10% and 7% respectively, which resulted in a net profit amount of $503 million for the 9-month period, an 82% improvement over last year's amount. Examining the balance sheet, total asset base shrank 4% to $10.7 billion, while total liabilities declined 16% to close at $5.8 billion. Finally, shareholders' equity amounted to $5 billion, relative to $4.3 billion in 2021. If we look at the next slide, Q3 profits are significantly better than Q3 profits last year, but still lagging relative to the last 7 quarters. They are experiencing low contractual rates since last year in respect of their Phase 2 operations, but again, the company still has room for growth. They are still managing to grow organically. They increased production by almost 9% for the period under review. They just renewed a 20-year license for Phase 1 of its operations. Phase 1 represents about a third of their business, so the company has already secured at least a third of their revenues for the next 20 years. They're also seeking to reposition the company as an alternative energy company, venturing into other forms of green energy production, for example, solar energy. And this ties in nicely with Jamaica's mandate to reach 30% renewable energy by 2023. Again, the company has plenty of cash, which places them in a great position to win some of these competitive bids coming up. As I mentioned earlier, you'll see on the next slide, the stock is trading at 89 cents at a PE of 14 times. But I did explain, how the company is well positioned for growth that can easily grow into that valuation within the next 12 months. The stock traded as high as 93 cents a week and a half ago, and we have seen where the stock has traded at $1. So I believe the medium to long-term growth for Wigton looks promising. What are your thoughts, Asha?
So I like Wigton. I think even though the PE is at 14 times, it is still attractively priced based on the potential that the company has. Next year will be 5 years since they have been listed on the market, and we are looking forward to seeing a few things happening then. We have seen where the volumes traded over the past month and a half has increased significantly. So somebody may be taking a position at these attractive prices. So PE may still be at 14 times, but I do believe it is attractively priced. So if your objective is really medium to long term, I think it's a good time to load up or create a position in Wigton.
Absolutely agree, guys. So let's watch how the company grows into this valuation coming into year 5. Okay, so up next, let's hand over to Asha for her to discuss SOS.
All right, so looking at SOS. So SOS is a Jamaican distributor of stationery and office supplies that has achieved improved financial performance in recent years. In 2022, the company experienced its most profitable year in its 58-year history, with all lines of business showing double-digit growth. Total assets in 2022 increased by 55% to $1.39 billion. Looking at their latest financial news, Q1 2023, the company showed continued positive performance. Revenues for the quarter were the highest recorded, again exceeding $500 million. The Seek brand, Evolve Furniture line, document deconstruction service, and sales in the Montego Bay branch all experienced significant growth. SOS also secured partnerships with the Office Authority in Trinidad and Tobago and received international export orders. The company's strategic approach to inventory management and improved purchasing processes contributed to this growth. Growth in the balance sheet is demonstrated with a 49% increase in assets to $1.5 billion and a 53% increase in shareholders' equity to $1.2 billion. Looking at the quarterly profit movement, SOS has demonstrated recovery and sustained growth in its quarterly profits. After a significant loss in Q2 2020, the company steadily increased its profitability, reaching a peak in Q1 2022. Despite some fluctuations, the overall trend shows a consistently strong performance. The company's strategic initiatives, expansion projects, partnerships, and product diversification have contributed to its financial success. So we're moving on to the stock price movement. The price movement exhibited steady price appreciation between 2020 to 2022, up from $5 per share to $20 per share. The price fluctuated earlier this year and traded at a low of $13.20. On June 19, which was last Monday, the board of SOS stated that they would need to consider a stock split. The company announced that at the next AGM, which is expected to be held on the 25th of July, they will move to recommend a 9-to-1 stock split. Since the announcement of the stock split, the stock has traded at a high of $34.31. The stock has since traded down to close at $21.90, which translates to a split price of $2.43. At the current price of $21.90, SOS has a PE ratio of 22.29 times, a book value per share of $4.79, and a price to book of 4.57 times. The stock is pretty illiquid, noting the total units traded in May was only 220,000. Looking ahead, SOS has a growth strategy in place. The company plans to invest in expanding its warehouse capacity and acquiring additional properties in Kingston and Montego Bay. It aims to establish distribution agreements with Caribbean businesses to facilitate regional expansion and explore e-commerce and technological expansions. Despite the potential challenges in the global economic landscape, SOS remains committed to driving optimal results and becoming a leading local and regional supplier of stationery and office supplies. Overall, SOS has demonstrated strong financial performance. They have strategic initiatives in place, and they are committed to growing. With its successful track record, expansion plans, the focus on customer needs, SOS is well positioned for continued growth and success in the future. So that wraps the overview on SOS. Rachel, your thoughts?
As you mentioned, Asha, SOS continued the trend of delivering strong quarterly performances. They're experiencing growth in all their revenue line that you mentioned, the highest growth seen in their Seek brand that they acquired back in 2018. The company is already positioning itself to increase its inventory levels and storage capacity across the island to meet existing demands and take advantage of the opening of new hotels and call centers. They're in aggressive expansion mode, and they have near cash of almost 300 million to fuel that growth. I think the business will continue to grow. They're continuously increasing their product offering, which is good. And I'm excited to see where the stock settles after the stock split. So this is definitely on my watch list.
And just to add, so the two companies that we have looked at today, they present opportunities for varying reasons. I know that currently the market or the overall market may be down as a junior market and the main market. However, we're seeing where certain companies are presenting specific opportunities. So if it is that you are an investor looking to invest for the medium to long term, I would say now is the best time to really start investing. Even if you already had a few of these companies, the prices now are cheaper than where you would have purchased it. So utilize the opportunity to average down or to create a new position, taking advantage of these discounted prices.
Excellent tip, Asha. Thanks for that. And that's it for today's discussion. Special thanks to our viewers for tuning in. We couldn't do this without your support. And to Asha, thanks for bringing your usual contribution to the panel. If you are curious about our updates on our virtual investor forum, then find us on social media. We share our live stream dates and upcoming guests on our official social media pages. So give us a follow and stay on top of all things forum related. Also, don't forget to subscribe to our YouTube channel, Mayberry Investments Limited, and click the bell to receive all notifications. Keep safe, and remember, wise investors, slow and steady wins the race. Thanks, guys.